And for more on the state of the stock market in China, we're joined by Justin Jiang. He's the Deputy Chief Investment Officer at Ping Capital Management. Justin, good to have you with us tonight.
Thanks.
All right, Justin, the Shanghai index over the last year up an astronomical 67%. For 2014, it was up about 55%. Yet the World Bank is cutting its growth forecast for China to 7.1%. The question is, are Chinese shares getting ahead of themselves? Can this momentum in the stock market continue?
First, I should say it's quite difficult to estimate the stock market based on economic fundamentals. Chinese stock market is mainly driven by policy and liquidity. For example, last year, stock up huge, but the economy was bad. The reason stock up so big is because, first, the liquidity provided by the central bank, the liquidity provided by overseas investors after the Hong Kong-Shanghai direct link. Also, the money moved out of real estate and entered the stock market.
So you're saying that the fundamentals are not there to support this rise and that this is a stimulus, a government stimulus rally. So can it continue? Do you foresee this momentum going forward into 2015, or is there a correction ahead?
I saw the momentum, short-term momentum still there until the Chinese New Year. And afterwards, I saw it will drop probably like 15 to 20%, and it will end this year up only very small.
All right, so a correction after the Chinese New Year, but investors are banking on more movement from the People's Bank of China. It did its first rate cut in November of last year, and it's speculated that the PBOC will have more loosening of the monetary policy and perhaps more stimulus. What is your take on that?
All these are already priced in. So people all expect the Central Bank of China to lower interest rate again in the next few months.
So it's already priced in. Okay, well, given this, and given you say there is going to be a short-term bounce, are there any sectors in the Chinese economy, in the Chinese stock market, that you are particularly optimistic about?
I'm still optimistic about consumer sector and the internet sector, and also industrial, and also some refining industry. But I'm not good at,
All right, well, you say the refining sector, and that's interesting because oil prices around the globe have been plummeting. China is bound to benefit from this. It imports, it's the #1 importer of oil. How will this impact the Chinese economy?
You know, China is the biggest oil importer in the world. So the lower oil price is very beneficial for China because it can cut the cost of agricultural and manufacturing. It can also maintain China's current account surplus. It can also control China's inflation. So it's very beneficial.
So do you think that that may help revise growth forecasts upwards then?
Yes, it will, yes.
All right, well, the launch of the Stock Connect between Hong Kong and Shanghai, that's been a big boost. Explain how that's helped the markets and how you see that playing out this year.
The Shanghai-Hong Kong Connect mainly benefit the Shanghai stocks. Why? The reason is Chinese institutional investors, they've been always be able to invest in overseas. They have the quote called QDII, Qualified Domestic Institutional Investors. So it's very easy for them to invest overseas, but it was very difficult for overseas investors to invest in China. Now, money flow to Shanghai most. For Hong Kong stocks, there are only very limited stocks that are listed in Hong Kong only. They are not listed in Shanghai. These stocks will get boosted.
All right, so we have more foreign investors in the market, and Premier Li Keqiang saying a Shenzhen-Hong Kong Stock Connect could also be on the cards. We're going to have to leave it there. Thank you so much for joining us. Justin Jiang, Deputy Chief Investment Officer at Ping Capital Management.